And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
No. I told you, no. I got the finger from Brent. Not the middle, though. Index.
Not yet.
Well, it's Financial Fitness Friday. CFP Squared. Rich Rosso, Danny Ratliff. Thank you for being here. No soup for you. Plenty of coffee, though. Plenty of coffee. Well, listen, we're not going to sugarcoat this. Futures look awful this morning. Guess we're down about close to 400 on Dow futures. S&P futures down. I don't know, but bonds are sexy again, aren't they?
Bonds look great. But, here's the deal. The headlines are always going to show you get things pop up on your phone. Oh, Dow's down 400. Dow's down 500.
But do you know what I did, Danny? I checked the news this morning, Google News.
Correct.
And I just put stock market correction in. And every major wirehouse has got, this is it, this is the end. Like the pessimistic news, it only took a couple of hours for, like you said, the candy of the, let's click on this link because it's the end of the
But
world
wait a
as we
second.
know it.
How many times have they done this before? Anytime we've seen a bit of a correction. And so my point was, though,
Yeah,
say Dow's down, 364 points.
Okay.
It's 0.9%. This is okay. This is something that we've been talking about. Now, I think what's more concerning is maybe things have changed a bit, where we went from bad news being good news in the sense that they were going to cut rates. Now maybe bad news is just bad news.
Yeah,
because
maybe
now,
the Fed's behind the curve, right?
Well, that's right. Maybe now they're having to cut rates because it's not the inflation front. It's the economic front. We're beginning to see jobs data starting to slow down. Kind of
Definitely
rolling
a
over to
cooling
some
labor
extent.
market. And we got the numbers today, right? We got non-farm payrolls today, 175,000 expected, 206,000 prior. So you're right. I think bad news is bad news, at least for now. But this number will mean a lot. And it's all this worry. Now the Fed is behind the curve. So the day before last, right, it was masterful. Powell was masterful. He came out and I don't know what he said, but he put a lot of icing on the donut. I mean, he flip-flopped. He was all over the place, but in a very, he's very articulate in his delivery. So the market sort of ate that up, and then all of a sudden the narrative changed. The most important part is when narratives change. And listen, Intel didn't help. I mean, one cutting the dividend, 15,000 layoffs. I mean, we see service ISMs really at poor numbers. We're looking at new orders at 47.3, business activity index 49.6, right? So we're definitely seeing a contraction in June. That's the second time in the last 3 months we've seen contraction. So this is not a good number. So obviously, we've been saying this, the economy is slowing down. I mean, people are out of cash, right? The stimulus coffers are dry. Credit card rates are where they are, and people are putting money on credit cards. We're going to talk a little bit about that later. So, but how many times do we get at least, even though we've forgotten, Danny, 10% pullbacks in the market, just like you're breathing? And that, by the way, doesn't mean your portfolio is down 10% because bonds are doing, what they're supposed to do.
Finally.
And yesterday, I looked at a lot of consumer staples, utility stocks, right? So there is still this rotation that's happening. I mean, I was looking at some stocks yesterday and realized, whoa, man, what a nice move higher today on some of these stocks. So it's not all dire. But yeah, Amazon's report was sort of They're down 8% pre-market. Right? So the balanced portfolio we were talking about, eventually, this concentration in all these tech stocks just not feasible. Eventually that unwinds. And that's what I think you're seeing now, even though it looks worse on paper. Or actually looks worse in the media than it probably looks on paper for most investors, especially if they're diversified, right?
Well, we've heard about the rotation trade, and we're beginning to see some, but really, I mean, when you look at it, I mean, Dow's getting hit. There's no place to hide except for cash, treasuries, gold as of right now. I mean, that's really been the only place. You know, and we talk about gold a lot. I mean, gold's one of those conversations that I think we get a lot of questions about. We don't mind gold, but, you know, I'm not going to go in detail on that one again. But, you know, the issues that we see, like Intel, I'll be honest, I'm shocked that it took this long to get this type of report. Intel's been a dog for how long?
Well, they really just tried to, you know, turnaround story. Listen, the AI was their opportunity, and they can't make it. And they're cutting the dividend, you know. Like you said, sometimes value stocks are not valued. They're value traps. But yesterday, you looked at healthcare stocks yesterday, looked at some of the consumer staple stocks yesterday, utilities yesterday. If you had some of these more defensive areas of the market, believe me, you didn't get hurt as badly as if you were fully concentrated in tech and some of the financials, right? And some of the consumer cyclicals. So to me, even though it felt bad, it was nice to see that bonds were up and some things, not everything was headed for the door. And plus we have additionally more cash. We have a little bit more cash on hand, and that's good. And I'm sure people have cash. So you just got to like chill on the headlines. Because, man, when I did that search this morning, Danny, I could not believe how many articles came up from every news source. Like 10, 15% pullback imminent. Time to get out of the market. I mean, if you're just a layman looking through this stuff, right, or a novice investor, you're like, oh, my gosh, what did I do?
Well, these times always remind me of, you know, years ago I had somebody with the same deal, and they came in the office, and this was probably 15, 20 years ago. They said, oh, my gosh, we've got to get out. I said, well, what are you going by on this? And I pulled it up, and it was actually on CNBC. It was Art Cash, and I think at the time he was a UBS floor trader.
Yeah,
and
that's right.
I pulled up all of his headlines. And one day he would tell people to run for the hills. The following day he would tell you, if you're not in this market, you're missing out. And it was based on the day-to-day narrative, because that's what generates those clicks. And so we have to remember, that what are we investing for? Are we investing for today? Are we investing for tomorrow? And how are we structured? What does your portfolio look like? What type of drawdown can you withstand? But also knowing that these drawdowns do happen, as you alluded to, the 10%. I mean, you've always said that's the cost of admission.
It is. It's the
you need to
how
be
many pullbacks
prepared.
do you usually get? We're just not used to them, right?
Correct. But I think where there's a glimmer of hope in this time right now, from a short-term perspective, you're right. There's other things that are working. We're not seeing bonds and stocks go down in tandem, which we saw in 2022. You know, if you look at intermediate
That's what
bonds,
I hate it, right? When everything goes in the same direction, man. When you have no diversification at all, there's nowhere to hide.
That's
there
right.
were places to hide. Give you an example. Walmart was up close to 2% yesterday, right? Some of the utility stocks were up close to 2% yesterday. The boring stuff worked yesterday. Bonds worked yesterday, all right? To your point, I would rather see that than what we saw in 2022, where nothing worked except for cash. Now, again, what if this non-farm payroll report comes out on target? You might see a bounce here. Not in Intel, of course. We get back, we're going to talk about the tale of two economies, the haves and have-nots, at the center of America's inflation fight when we get back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So yesterday I had an interesting conversation with somebody, and I'm sure many of you have heard of the bucket method of money, right? I have money in different buckets. I have a cash bucket, right, where I replenish that cash depending if I'm in distribution strategies. But I have a client yesterday. Well, actually not a client, but someone I talked to yesterday. He said, I have my 20-year money, I have my 10-year money, I have my 5-year money, and I have my 2-year money.
There you go.
And that's how I look at it. He goes, I have my 20-year stock money. I don't worry about it. I don't have to worry about it. If it goes up or I don't worry about the fluctuation, right? I have my 10-year money, which is a little more blended. I got my 5-year bond. He's laddered out 5-year bonds. I got my 5-year money, and then I got my 1 to 2-year money in cash. And he goes, I don't worry about my 10 and 20-year money. In some ways, I know that's mental accounting and bucketizing it where you're not looking at money as a whole, but I like the way he does that from an emotional perspective, because he says, my 20-year money, I don't care what it does. I've got it blended. I've got all sectors. But I don't worry. I don't fret that 20-year money, right? I'm 65 years old, right? If I don't live to 20 years, this money goes to my kids anyway. It is 20-year money for me. So I really like the way he does it. And he goes, it keeps me balanced in my head. And I thought that was brilliant, because anything you can do to battle the emotional ghosts and demons that you have that are going to cause you to make a bad decision is a good thing.
Yeah, I think so. And
so
I think
that's how he does it.
Well, but I think most people probably do that already. They just don't think about it that way.
Right?
Right?
He actually separates it out. Like, he's got different accounts for it and all that. So he doesn't even look at it. And so in other words, what I'm saying is he looks at it as a whole through an aggregator, right? So when he looks at it as one piece. But he doesn't want to focus on, and he uses indexing for that 20-year bucket. But I looked at it, and it's very blended. He's got growth, value, right? He's tackling all areas. It's 100% stocks, right? So
in his 20-year money, right?
That's the 20-year money. And he goes, listen, I don't care. It's not like I'm picking individual stocks. In 20 years, my thought is this is going to be higher. And if I'm dead, my kids.
And I'd agree.
And I worry about my 5-year money, my 1-year money. I worry about that in some form. And he goes, and I'm like, listen, whatever works for you to not make a dumb decision when everybody's telling you to get out. It's just so funny. We had one of the best days a couple of days ago that I really ever seen. The breadth, the volume. I mean, it was a picture perfect, like Cinderella, like I'm out in the woods, happy days, sun is out days, right? I mean, it was amazing. And then all of a sudden, the narrative changed. So that's what you're going to have to deal with for the rest of the year. And Lance talked about this. August was probably going to be a really good time to see that pullback in markets. He's been talking about the summer doldrums and all of that, and that's, I think, what you're going to see right now.
Well, this is a mirror image of last year in a lot of ways, except the economic data has weakened, I think, a little bit more than where we were. But this should not come as any surprise. This is something that we've seen. We've been expecting. We've been watching the numbers. So if you just follow the data, I mean, look at retail sales, look at credit card delinquencies, look at the balances on credit cards. That's just the consumer side. But then you begin to see, okay, well, what type of stimulus is still there? I know there's still money in the coffers with the Inflation Reduction Act, but that's not fast money. That's not shovel-ready jobs. So I think this is going to be something that will ebb and flow for some time. And obviously, where and in the state of Jerome Powell, this is transitory. It's going to continue to move. And we may get some data that looks a little bit hotter or a little better than expected. We may get some that's weaker, but in a time like this is not uncommon. So I think by what you just mentioned that this gentleman was doing is fantastic. Now, for many people, that's pretty cumbersome, and they may not be able to have the bandwidth or just the time to do so. But I would argue that a lot of people already do this. I would say the majority of our clients already have cash on the sidelines or cash in their account. They have bonds, right? So cash, that's short-term money. They have bonds. That's cash is going to be looked at for that safety, preservation if you need income, but also flexibility for opportunities. So, we should be looking at these times as something of opportunity. Like you said, Lance has been talking about this. We were due for a pullback. Market breadth for the last 18 months has remained relatively poor.
Absolutely.
And so is this a time where we do see maybe, this thing kind of settles down? We see tech has that pullback. And like you mentioned, the Walmarts, the consumer defensive, the other areas, utilities, they do well.
AbbVie had a great day yesterday, right? A lot of the farmers that have been dogs had a great day yesterday. So we have been balancing out this two sides of the economy, right? Where we do have tech, but we also do have value in the portfolio. We have owned, and again, this is not a recommendation, but we had owned Stanley Black & Decker for a long time. We took profits in that, but there was some sector rotation into small cap, right? So you got to have some of these more boring things in your portfolio because they do help manage the turbulence. Boring is sexy again. Bonds are sexy again. And that's okay, because if you own both, you're going to have eventually a buying opportunity in your tech area, right? Maybe not Intel, to your point, Danny, which has been a value trap, but maybe Amazon and some of these others. Amazon didn't have a completely bad report at all. So, and it's getting hit this morning. And then I have American Electric Power, and that's up 3% yesterday, and Duke Energy and all these other real boring stocks that haven't worked. Because if rates pull back, obviously dividend stocks will be the way to go. So, and we did trim out some stocks. I guess, when did we trim? A couple of days ago?
No. Well, yeah, a little bit, but we've been trimming for the last month and a half, give or take. So just little small moves. And so, if you're looking at this and you're thinking about your funds as buckets of money, that doesn't mean you just set it and forget it. I do think you need to look
rebalance
and set those rules. When are you going to rebalance? If something goes up X amount, do you begin to take profits? Do you look at, or is there more momentum to it? I think that's the challenge that many people are faced with at this moment is, where do you go? What do you do? And, the problem is we have that high water mark that we always look at in an individual stock in a portfolio. And there are times that, we're waiting for confirmations. We're waiting for, a handful of different data to come together.
Yep.
And that can be the difficult aspect on this, because if we're just looking at one piece of information, this thing can change very quickly, like the narrative from Wednesday to Thursday.
Yep.
That's a big difference. And so when we begin to think about, okay, what are those rules that we have in place? How do we need to go in and start to trim and or reduce exposure? Now, you may say, hey, this is 20-year money I'm not going to touch. But if we can move from one vehicle to another and it's going to get you to your destination quicker, well, then by all means.
Maranta, I think healthcare, utilities, and bonds are sexy, not foundational. I'm kidding. It's a good way to look at it. Boring, foundational.
Yeah.
So I mentioned this a few days ago, but depending on the client I'm talking to or the person I'm talking to, I put on a different hat. And what I mean by that, there are two roads in this economy. There is the older boomer road, for the most part, who have no debt, have stock market wealth, housing wealth, and yeah, inflation makes them sort of grimace, but it's not bothering them as much as, I say, more middle-class families, low and middle-income Americans who are seeing that, listen, they live paycheck to paycheck, right? They're income-oriented, they have debt, and they are seeing a different world. So depending on the person you're talking to, you have to have different lens and different ways of looking at their lives. So inflation is definitely hurting that group. So even though there's resiliency among consumers, especially middle-class consumers, and they may be making more money on a nominal basis, they are truly hurting. And that's the one thing, Danny, I think tells me the most that slowdown is here, right? We are seeing those cash coffers dry up and inflation remaining sticky. Yeah, the rate of change, we always talk about the rate of change is in the right direction for inflation. But the baked in the cake, as we call it, inflation, when you go to the store, those prices are elevated over the last 3 years. Matter of fact, if you look at real household incomes over time, when Trump was in office, $78,250. Under Biden, $74,580.
But inflation,
that's real
has
money.
Grown.
Yeah.
Right?
That's why. That's real dollars are down. You know, if you're making, when you look at wages, real wages, your wages are down over the last 3 years. Now, you might have gotten a promotion. Your job might be secure. So this is a great article in the Wall Street Journal. But Nicole Lewis, she's a mother of three. She lives.
That's the best quote in there.
Isn't it?
Yeah.
This is the most money we've ever made, and this is the brokest we've ever felt. I thought that line summed it up beautifully.
Yeah, but that is a picture of most of America.
Mm-hmm.
And you know, she's probably a little different because she's saying this is the most money we've ever made. I know people that are, you know, they're making what they made 5 years ago.
And they're making more than $90,000 a year.
Yeah.
Yeah. But everything, groceries, auto insurance, look at insurance, right? And people are depleting savings. They think they're getting ahead. Then they get the homeowner's insurance bill or the auto insurance bill. So now what's happening, and we've seen this, middle class, lower middle class buying goods on credit, right? Juggling cards to keep the credit score up, but also balance transfers. It's this game. Thrift stores are in, right? So all this talk about, well, look at all the jobs under this president. Look underneath the surface.
Wait. That's such...
What?
all the jobs because we shut down the economy. Don't get me started on that.
No, I want to get you started on
I
that.
get it. I understand. Yes, that's true. There's been jobs. But let's talk about why.
Listen, we're going to get him riled up next session when we get back. Rabbit Danny next.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
We always say cash flow is the lifeblood of retirement. For a middle-class family, income is the lifeblood. And median earnings are about steady over the last 4 years, but inflation isn't. And that's a problem. So sooner or later, this all comes to an end. Unless, again, the government wants to just hand out checks again, which you never know.
Well, at $35 trillion.
Yeah, what's
debt.
what's $35 trillion among friends?
Well, in 15 over the last, 3.5 years. That's the thing, right? And everybody talks about these inflation numbers. And I know, yes, it's very important, and we do want these numbers to come down. But we're not in a deflationary environment as of yet, and I don't think most of you really, really want that. Because if we get in a deflationary environment, what's going to be cut? Because before prices are cut, jobs are cut. So
well, we're going to start seeing that now.
Yeah,
right?
and
we're going to start seeing layoffs. And again, that's why I'm really interested in this non-farm payrolls report for July today. Yes, I agree, Danny. Deflation. Sometimes a little inflation is actually good. It's just where it's gone that we can't handle it. But sometimes a little inflation for pricing power purposes, for wage growth, is not a bad thing.
We always want a little inflation, but we also want wage growth to keep up with that. Mm-hmm. That's the key.
Yeah.
Now, the problem is, yes, you mentioned that number from 78,000 for a median household to 74. That's a big difference. Now, also with, yes, we see inflation at a much lower pace, but that doesn't mean we've gone backwards. We haven't erased the 2020-21 inflation print. That number is just not climbing as quick as it once was. And so now with people, facing all the challenges that they are with those higher credit card balances, with, trying just to make ends meet, depleting savings, this is where it begins to get really difficult. And I think that's why you're going to see the Fed pivot. Now, can they pull off the soft landing that they've been trying to achieve for so long? That's yet to be seen. I mean, as of now, we could probably argue yes. because we haven't seen. I mean, yes, we're seeing things slow down. We're seeing economic data that was kind of what we expected over time.
We keep track of credit conditions, and credit conditions are fine, right? We're not looking at.
Well,
I'm just saying is for the most part, like you said, I think next year you're just in for a muck, and I mean low growth, right? Inflation still maybe a little bit above Fed target, and it's just not going to feel good. I mean, I still think we're probably in for that, but like to your point, the market jumps to big conclusions based on these narratives, and that causes disruption. But again, households are hurting.
Well, they've been hurting.
They've been hurting.
Since
right?
October, we've had last October, we had the highest credit card balances that we'd seen, right? And so you think about it, and common sense would suggest the market or the economy would follow or both, and they haven't. Now, we haven't seen that wide participation that we would love, but markets have still gone up. So if you're in the index, you've done well, even with this bit of a pullback that we've seen here. Markets, they roared the first half of the year. So I think this is the challenge, is that we look at things, we want to rationalize it all and say, okay, well, all right.
That's how our brains work, yeah.
But it makes sense. But now the problem is that with inflation still there, it's still rising. Wage growth has not kept up with it. But because we had such a significant increase over the last several years, just to make ends meet as people depleted those stimulus checks, as you alluded to a bit ago, now maybe this is when the rubber meets the road.
Yeah, we thought post-pandemic things were strange, but now we're going back to pre-pandemic conditions, but some things have definitely changed. And that's what we're going to see that the market is going to have to work through. And that's not going to be comfortable. So this tale of two economies is something I've been talking about for 6 months, for me personally, depending on the person I'm talking to. There's a perspective your financial advisor needs to have depending on the economic DNA of that household. Because some people aren't hurting. Some people are taking cruises. Some people, and again, it tends to be your older, retired, fiscally responsible people who have done this and didn't realize housing was going to increase the way it did, didn't realize stocks were going to have such a good year, and they're spending a little more money. Now, I'm not saying they're not cutting back on certain things because they always have been fiscally responsible. But again, if I talked to a family, they're both in their early 40s, they have 3 kids. It's a totally different world for them.
Yeah, much different.
Right there, look how much your child care costs now. If you had to look at the way you want your children to be taken care of while you're at work, I mean, it's exorbitant. People can't afford that.
I was talking to somebody the other day. They're in the Hill Country, and I want to say for one child, not even for a full day, but through the week, it was something like, I don't know, $500 bucks a week.
Right, $500-600.
So you're talking about for one child, this is $2,000 a month. So then you start looking at, okay, well, shoot, if you're a 2-income family, does it even make sense depending on what you're making for one of you to work? Should you stay home? You start to just add up all the additional costs that are associated with it, which I get it. That's why we've seen the birth rate decline. It is expensive. I mean, I've got 3. I can tell you, they're not cheap.
Imagine if you had to place 3 children in childcare at $600 a child.
I think you'd be better off finding somebody to come to the home, right? Paying a loved one, paying somebody, finding a nanny. I gotta believe that would be cheaper.
But this also goes into why our demographics suck, right? People don't want children, and some of the reasons why it does tend to be financial for people who do even want children. And we need babies, right? We need kids. We need merit immigration, but that's not merit-based immigration, but that's not going to happen. But we need people. I mean, we're still better than China and some other countries, but for the most part, when I talk to younger couples, that even want children and they have good jobs, they are scared to do it. Besides the climate that they're not feeling very good about things. It's more of, my gosh, the costs.
Well, I think people are waiting longer as well.
Are waiting.
It's not where, early 20s, you're getting married and having children, you're waiting a bit. And, I'm guilty of that as well, where we waited. We wanted to, hey, we wanted finances to be there. We wanted to be set in our careers. And, in hindsight,
I think that's smart.
Well, yes and no,
that's
right?
How I looked at it.
But also in hindsight, I look and I think, well, kids don't care how much money you have. Kids, look, as long as
unless you're living in a cardboard box.
They're protected and they're well fed. Shoot, I get a cardboard box. All my kids want to do is go make a fort out of it or something.
Until they say, listen, tonight we have to stay in the box because this is our house now.
Oh,
then it would be a little bit different. Remember the refrigerator boxes? Man, as kids, we loved those. We did put one kid in the refrigerator, but that's a bad story. We didn't like him very much. But the boxes were amazing.
Yeah. No, and that's the way it is. And I understand, but I also don't think, I think sometimes that we think too far into it. And, you can still make ends meet. You find a way to get it done.
Well, I don't know, but Greta says the planet was supposed to be gone by now, so maybe you don't want kids if the planet's going to blow up.
Yeah.
So you got to be careful.
I will.
The one thing that I never knew I wanted children, but having my daughter is one of the best. It's just one of the best things that ever happened. It's like after the fact, you realize, oh my gosh, this is so amazing to have a child and see them contribute to society. It's very worthwhile. I've got grandcats. I don't think I'm going to go beyond that, but
Well, I do think it's fulfilling. It's funny. Lance and I had lunch with somebody, I don't know, a couple weeks back, and they said, "Hey, I just don't get it." Like, they didn't have children, and they're in their 60s, and said, I never had kids. Wasn't necessarily like something I didn't want per se, but just never did it. Right, focused on business, built this. But like, what am I going to do with all the funds that I've accumulated over the years? And
I think as you get older, that's when you start to realize, would it be nice to have grandkids? Would be nice to share lessons with them now that I know a lot more than I did 25 years ago. T.S. Leon goes, we can have AI create children. It's a brave new world.
Oh,
you probably can.
Yeah, they're trying to clone humans, or they probably already have. But Lance came back and said, you know what? Sometimes it's just tough to describe, but once you hold that baby, it changes.
It does.
And it really
Your whole
does.
perspective changes.
It does quite a bit.
It scares the hell out of you. Because you're like, oh my goodness.
Well, I think it gives you a sense of purpose, and you want to see things, and I think that
it's a grounding kind of situation, right? Your thinking automatically changes, doesn't it? When you first hold that child, and you realize you will have to do everything you can to protect that little person. The way you handle money, usually, insurance, it just changes.
It's like a dividend paying company. You have to be a better steward of capital. You have to be on top of your game, right? You don't want to cut that dividend. You don't want to not feed your child. I think that in a lot of ways, so, we talked about political narratives and we talk offline a lot on what's going on. And J.D. Vance said...
Well, we call it screaming.
Yeah, J.D. Vance, what did he say recently? He said, I guess basically like Kamala had no skin in the game and equated her to a single crazy cat lady. And I know what he meant. Now, it was very poorly worded in what he was saying, but I think what he was alluding to was like, hey, I want to make this place better for my children.
Yeah, and I think his description was sort of accurate. When we get back, we're going to continue this discussion. Maybe, if we're still on the air.
Rich, how many chihuahuas do you have?
Like a tree of them.
Are you the equivalent of the crazy cat lady?
I am. I absolutely
It's the male version?
I am the male version of the crazy cat. And I guess what, though? I own it, and I'm proud of it.
I love you.
When
I'm just messing with you.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
It's a good hire. Lean into your strengths. Oh, we'll spend another minute on this and we'll go to this. This RMD rule is so confusing. Terribly confusing. Are we on the air? We're talking about RMD rules and how the IRS just makes it worse.
They've done nobody. They have done nobody any favors with the RMD rule. I mean, every year it's a moving target.
300 pages on the RMDs for IRAs and 401ks. So we always talk about your IRA, your pre-tax IRA, as the fatted calf. And the government is always clawing at it, wanting that money. Roth is not the problem, pre-tax is. So you have the 10-year rule, generally speaking, for non-spousal IRAs. Your children inherit your IRAs, your friend, your cousins, whatever. They have to take that money out over a 10-year period. But what if the person who passes away was already in required minimum distribution mode? In other words, they had a table that they had to follow for life expectancy and they had to take money out. Well, the IRS was really sort of confused, didn't know what to do. Well, okay, we know we want this individual to take the money out over 10 years because we want our taxes. That's great. But should we at least be putting in the RMD if the person who passed was also taking required minimum distributions? And my thought was eventually that was going to happen because when I always think about the IRS, I always say, who does it benefit? If it benefits me or my family, then most likely that's not what's going to happen. It's what's going to benefit the government and the IRS. And thus, that's what happened, right? So now we got this annual RMD rule for non-eligible designated beneficiaries. And again, it's not a surprise. It's just, why did it take so long to actually codify this? So I guess, Danny, the most confusing part of this, well, first of all, if you have a non-spousal beneficiary IRA and you are in the 10-year rule, it's an art form to take money out. See, if you inherit a Roth IRA, say my daughter inherits my Roth, well, she's got 10 years to take it out, but why would she even bother? Just take it out in year 10. It's all tax-free. Unless she needs the money for some reason, right? But if I have, well, you leave a large IRA to a non-spouse, and you have children that are in a decent tax bracket, then it could be a burden for them. So every year they have to look at, do I take an RMD this year? Do I not? Right? You've got to come up with a strategy.
Correct.
A tax-effective strategy to take money out of that account. But I think having the RMD requirement throws a wrench.
Well, it does. It doesn't give you that flexibility now. We can't look at, how do you take that distribution out? Should you do so in a year where maybe you're not working as much, or you're not working, maybe you took the year off, you've been let go, you're looking for a new job, whatever it may be. That is typically when we want to look at saying, okay, do we go ahead and do a little bit more now? But when you're required, it's not going to matter. We were looking at Roth conversions, discussing it with somebody yesterday, a couple, and we were talking through it. I said, wow, well, this could be a great year. They actually just left a job, said the job was just way too much. Great financial position, probably because they have no children. Talking about that,
Crazy
I was thinking about that. I was like, actually,
crazy wealthy cat people. They're using dollar bills for cat litter.
Right. Well, it is funny because we talk about that, and we know so many people that don't have any children, and they're great stewards of capital, and they do such a good job with it. But so we were talking about just in general, like, okay, so if you're not going to work, or maybe do some contract work till you find what you really want to do. This is a couple where they've done the hard work, like looking at what they've done over the years. Like, I'm super proud to see where they are today. And I said, what, if anything that you should take today is that you have peace of mind from this conversation, that you're in good shape. Even if you did not want to go back to work, all the things that you want to do and achieve, you can do so. Now, with them, we were talking about, how do you start making distributions, or should we do a Roth conversion now? And for them, in this instance, we start thinking about, like, well, shoot, and they have beneficiary IRAs. But what, okay, we're going to have to take a RMD, actually got a severance before they left for another job. So they are kind of double dipping all year. They've made just as much money this year already as they would if they worked all the way to December. So where a year where maybe we thought it was going to be a great time to go ahead and supercharge that distribution, it wasn't. So that type of flexibility is nice to be able to have, which is going to go away essentially.
Yeah, and this non-spousal inherited 10-year rules are different. Like Sally Staffon was talking about, she goes, RMD rules, lucky my mother-in-law passed away in 2019, I'm sure.
So before...
Mr. Staff is real happy to hear about that lucky comment.
Well, but
you're right, though. Before...
Your grandfathered in.
You were grandfathered in, and your beneficiary would be taking that money over their life expectancy. Big difference compared to when the Secure Act came out. So if you have someone, say, for example, they had a parent who passed away 4 years ago, and that parent was taking RMDs, and the government said, don't worry about it. We don't know the rules yet. Don't worry. You don't have to take it. And he or she waits. That means now they have only 6 years. It's a ticking tax time bomb. And you have these 22 and 24% brackets that might be squeezed shut on you a little bit when the Tax Cuts and Jobs Act is most likely going to sunset. I can't imagine it being around, Danny. So we always say you got to prick that IRA bubble before required minimum distributions, just in your own IRAs, right? Tax control that you have before the government forces you to take it, whether it's 73, 74, or 75 in the next, 9 years. Right? It's an art form to draw from those IRAs. When people retire, I still have people who retire, Danny, and they have IRA and non-IRA assets, and they're still in the old mindset is, I'll draw down the non-IRA brokerage account first, and I'll let the IRA sit and grow. And I'm like, no, we're going to do the opposite of that conventional wisdom that was popular in the 90s. That happens to be in your head. We are going to tap the IRA first. Part of what we do, two-pronged strategy, depending if it's beneficial or not. One, I'm going to take out money out of my IRA, and then I still have my room in a bracket. But Rich, I don't need that much money. No, I understand. But guess what we're going to do? We're going to take the rest. We're going to parcel it out, and we're going to place it into a Roth, right, Danny?
That's right.
So you can go ahead and maximize the use of the tax bracket, even though it may not be what you need to take out. Do it before the government forces you to do it. And guess what? Who knows, Danny? Because, again, the government is always looking at that fatted calf, rubbing its hands. They want that pre-tax money so bad. Who knows what comes out with the way our deficits are in the future, right?
That's right. That's exactly right. So remember the
what
required...
do you always say? It's between you. You're the partner.
It's a partnership between you and Uncle Sam. So you may think you have $1
no
million
say, right?
in an account, but you really don't. Mm-hmm. And if they, the unique aspect of it is they can change their ownership percentage.
Yep.
And so we can't do anything about that. Now they want more, they get more. And so that's the challenge here. And so that's why we want to take advantage of this current tax code. Maybe we do have this lower for longer from a tax bracket perspective. That would be fantastic. But, with looking at debts and deficits and budgets and everything else, I would expect them to increase it. And what we're beginning to see, everybody said the Roth is going to go away. No, they're actually pushing the Roth now. They're allowing more access to it. And because they want those tax dollars now because of the situation that they're in.
Yep.
And so, we have to remember the RMD, that required minimum distribution, is when you reach, currently now it's 73. It's going to go up in 2033 to 75. But they look at your December 31st balance, and based on your age, there's a uniform life table is what they call it, the IRS does. They're going to give you a divisor. And so it starts off at 26.5. And then you have to divide your balance on 12/31 by that number. Now, each year that will go up. Somebody on the chat said, well, that's, a good dividend pays more than that. Well, yeah, it does. 3.7% give or take in year one. A good dividend will, but the average S&P dividend right now is 1.32. Long term, it's a little over 1.8. Mm-hmm. So you're not historically, you're going to need that growth to keep up with it. But each year that number goes up on what they require you to
your
take.
Life expectancy goes down, so that withdrawal rate goes up. T.S. Leong's got the best comment. She goes, who would this really benefit, the Secure Act? The government or the people?
Oh, come on. We all know that. It's for us.
It's to make our lives better. The one thing I do like about the Secure Act, blasphemy, is the Rothification. People telling us Roth's going away, and anything but. Roth has been bolstered because the government is J.G. Wentworth and needs money now. Take advantage of that.
That's good for you. That is
good for you. Okay? That is where, and we're going to see much more aggressive stance on Roth coming up, right? Matching contributions in Roth. Catch-up contributions. So Roth is the king. All right, you all have a great weekend, everyone. Sign up for our newsletter, realinvestmentadvice.com, YouTube channel. We have a lot of, more Candid Coffees, Lunch and Learns in the future. Hope you stay tuned for that. Monday, Lance is back. We love you. Take care.